Hello, Business 202. This Hangout describes Chapter 19 and a job order costing system. It is a continuation of Chapter 18, and what it tries to do is to give more detail about the structure of the accounts used to account for a job order costing system. This is the second in a series of 3 chapters on manufacturing accountant. Chapter 18 was an introduction. This chapter, Chapter 19, is for a job order cost system, and the next chapter, Chapter 20, is for a process cost system. What you should be able to do after reviewing all 3 of these chapters is to distinguish what type of manufacturer would use a job order cost system as compared to a manufacturer that would use a process cost system. First, what is a job order cost system? A job order cost system best fits a manufacturer that does custom or specialized type work. The easiest example to see would be a house. If you are a housing contractor, the house that you make in Harrisonburg is going to differ from the house that you make in Stanton or the house that goes up in Winchester. Because they are specialty items, the materials, the labor, and the overhead that would be involved with each one would differ. And so you want to have your chart of accounts accumulate costs for material, labor, and overhead for each one of those specialized items. The chapter uses the example of guitars. Here you have the Washburn Guitar Company that makes the guitars for the Paul Stanley from the band Kiss. These Legend and Jazz Series guitars represent 2 different types of jobs that require different type of polishing, different types of strings, different types of wood that go into these 2 types of guitars. And so they treat these 2 sets of guitars as separate jobs. Process cost systems are those systems that where one unit is not special from the other. It's a continuous process, and one item looks very much like the next item that's going to happen. Most chemicals, like milk, like soup, like gasoline, would be an example of a process cost system, because the gallon of gas that you make today was very much like the gallon of gas that you made yesterday and will be like the gallon of gas that you make tomorrow. Okay, let's get into the details of this job order costing system. And I think it would be a good idea if you would open up your textbooks to page 873 for Exhibit 1, which starts this particular the discussion. Okay, the groundwork is that the balance sheet for a manufacturer will have 3 types of inventory. Materials inventory, which would be raw materials that would not be worked on. Work in process inventory, which in this case would be guitars that would be partially finished. The finished goods guitars, which would be the Legend guitars versus the Jazz Series guitars. And then finally, the cost of goods sold for those guitars that have been moved to the retailer's establishment. What you should be able to do is to picture each one of these processes in the factory floor and associate them with the chart of accounts that a manufacturer would have. And what you see here is Exhibit 2 on page 873, which shows the material inventory cards. Here you have the control account, which represents the sum of the maple, oak, and hickory wood raw materials that would go into the guitars. For this example, the work in process inventory account consists of 2 jobs, job number 71 and job number 72, which are in process, and the finished goods inventory, which would consist of job 69 and job 70, which would be these finished jobs here that are sitting in the warehouse awaiting distribution to the music store that ultimately will sell the guitars. Okay, now what your text has done, beginning on page 874 with Exhibit 3, is to show the detail behind the schematic that you see here in Exhibit 2. Eventually, what we are going to do is to show all of these items roll up into the work in process account and make the journal entries that create these items. Okay, so let's just get right to the meat of things, and let's move directly to Exhibit 8, which is on page 885, and this exhibit pulls all the information together. So what we're going to do is to go back and forth from Exhibit 8 to the various pages in the chapter where this information originates. And let me just increase the size of the screen a bit. And now I think you can see that a little bit better. Okay, so here you have the raw materials account, the work in process account, the factory overhead account, finished goods, and cost of goods sold. Ultimately, what we want to be able to do is to make financial statements, specifically the cost of goods manufactured and the cost of goods sold, from these accounts. Items below the control accounts will be the subsidiary accounts for materials, for work in process, and for finished goods. Okay, so let's start. At the beginning of the period, which this is for the month of December, the materials account, raw materials of the various wood, started with $6,000 for the maple wood, and then there was a $500 amount for glue and paper, which are known as indirect material. Direct material becomes a physical part of the completed unit. Indirect material are materials that are used, usually used up, and do not become part of the physical item. They might be the glue that's used to temporarily hold some of the frets on the guitar, or to glue the guitar parts together. In this case, sandpaper might be there. We could have oil to grease the machines. All right, so these would be indirect material, and they would be classified as factory overhead. Beginning of materials was $6,500, and as you see on page 875, the company purchased $10,500 worth of material. So the entry that would be made would be an increase or debit to direct materials and a credit to accounts payable. This would be shown as a left-hand or debit entry to the materials account. Also, the subsidiary ledger, Maplewood, would be increased by the same amount. Next, some of these materials were requisitioned from the materials store to the shop factory. And in this case, again, on page 875, there were $13,000 worth of materials that were requisitioned. So the entry that the company would make is an increase of $13,500 to the work in process to represent the materials that have been moved to the shop floor, and a credit or a reduction to the materials account to show that items have been removed from stores. Third item is that individuals will work on the guitars, and in this particular case, on page 876, the company, using its job cost sheets, have accumulated $11,000 worth of labor. And if we would go back to Exhibit 4 on page 874, here are very small items of the job cost detail. But these two items here represent job tickets. And as workers would work on a particular guitar, whether it would be the jazz guitars or whether it would be the Legend model guitars, they would log their time according to which guitar that they were working on. Each individual would have a wage rate, and they would indicate the number of hours that they would work at a particular station. So their wage rate times the number of hours would give the total time that they would have worked on a particular guitar. The individual workers would have their own job tickets, or in today's manufacturing, workers would have swipe cards very similar to your Bridgewater College access cards that would keep track of their time. And these job records, when they are added up, would show direct labor for job 71 of 3,500. And for the second job, job 72, all of these individuals' job time tickets would add up to $7,500. So the amount accumulated for job 71, 3,500, plus the amount accumulated for job 2, 7,500, together would amount to $11,000, and that represents the direct labor that we would charge work in process for. So we would have a debit or an increase to the work in process for entry C of $11,000. Okay, now materials and labor are known as direct costs because they can be directly associated or directly traced to the final product. Overhead, which represents all of the other factory costs exclusive of labor and overhead, are a little bit tougher to do because there are so many of them, and so an average is calculated. So in calculating a particular average, what the company would do is to make an estimate at the beginning of the year. And it would work a little bit like this. If we draw a timeline that would represent the beginning of the period, and for this particular example, it's for the month of December, and the end point would represent the end of the period, something called a PDR, which would be a predetermined overhead rate, would be established at the beginning of the period so that during the period, overhead could be allocated to the appropriate jobs. The predetermined overhead rate is calculated by taking the estimate of the factory overhead cost that the company budgets or believes it would have for the month of December in this case, and divide it by the estimate of something called an activity base. This activity base, or sometimes known as a cost driver, represents the activity in the shop floor that would drive overhead costs up or down. For our course, direct labor hours will consistently be used as the activity on the shop floor that would cause an increase or decrease in factory overhead. So for the but the Washburn Guitar Company, the factory overhead rate is shown to you on page 879. And for the month of December, at the beginning of the month, the Washburn management believed that there would be $50,000 of factory overhead costs that would be incurred, and they believed that they would work a total of 10,000 direct labor hours during the month. So what that means is that the Washburn Guitar Company would have a predetermined overhead rate of $5 that they would use to allocate factory overhead costs to work in process during the month. This is a calculated value, and it represents the average cost that the company might incur. Of course, estimates are just that, and they could be incorrect. At the end of the period, the amount of overhead that's actually incurred could be more or less than predicted. What happens in a case like that? That excess would either be charged to cost of goods sold if there would be underapplied overhead, or it would be deducted from cost of goods sold if there would be overapplied overhead during the month. We will show that calculation in a moment. But for the time being, let's use this $5 PDR, predetermined rate, to allocate overhead costs to work in process. Okay, so this is how overhead is allocated. This is on page 878. It says that the company used $500 of indirect materials. Now, remember, the indirect materials are those materials that are not directly part of the finished product. And these would be the glue and the sandpaper that would be used. These two together would be materials whose cost would be allocated to the factory overhead. Also, there would be $2,000 of indirect wages. This would be like inspection wages, shopkeepers' wages that clean the factory floor, and the work that's done that is associated with the factory, but not exactly working on the guitars. Also, there would be heat, light, and power associated with the factory, and for Washburn Guitars for the month of December, that would be $9,000, and there would also be $1,200 of depreciation on the factory building and the factory equipment for the month. This is explained to you on pages 877 and 878. The total of the materials, indirect labor, utilities, and depreciation for the month of December totaled $4,600. So that is the amount by which factory overhead would be increased. And you can see here in the factory overhead account that the indirect materials, wages, and depreciation have been charged to the factory overhead account. Okay, now, next item is that certain of these guitars were finished during the month. I apologize. Next what we want to do is to apply this overhead to the work in process account. Even though the company incurred $4,600, how much of the overhead would be applied? Well, let's go back to the calculation that we had here. We know that the overhead predetermined rate is $5, and we also know that the activity base or cost driver is direct labor hours. So up to this point, we would have to determine the number of direct labor hours that were worked during the month. And that would mean that we would have to use the information from the time cards that we would have. And if we would go to page 879, we can see that there would be, you folks will have to go to page 379 because this illustration is just a bit small for clarity on the screens, but you have 350 hours associated with job 71 and 500 hours associated with job 72. So 350 and 850 would give you 850 hours. So 850 direct labor hours times the $5 predetermined rate would result in 4,250 as the factory overhead that would be applied or allocated to the work in process account. Okay, so the next entry, entry E, which is on page 880 of your text, would increase the work in process account by the amount we just calculated, $4,250. Here it is right here. And also reduce the factory overhead account. And here that credit appears in the factory overhead account. Okay, now let's examine the factory overhead account. Let's add the total increases or debits to the account and the total credits that we would have to this account and get a balance. So adding 500 plus 900 plus 1,200 plus 2,000 to get the total of the increases, that's the 4,600, that we incurred in this entry here, less the credits in this account, minus 200, which would be the beginning balance, less the 4250 that we just applied, leaves a balance in the factory overhead account of $150. Because the business must account for all the manufacturing costs during the period, this factory overhead account must show a zero balance. In this case, because we did not apply enough factory overhead to work in process during the period, we only applied $42.50 when in fact the business incurred $4,600, we must make an adjusting entry at the end of the period, making this account zero by crediting or reducing this account by $150. For simplicity, that $150 under applied overhead will be debited or shown as an increase to the cost of goods sold account. Okay, so as a check for factory overhead, at the end of the month, if the total increases during the month less the total decreases during the month, leave a balance in the factory overhead account. In this case, there was a debit balance or a left-hand side balance of $150. To make this account zero, we would decrease or credit the account $150 to make the balance zero. And the opposing amount, in this case a debit, would go to cost of goods sold. A debit balance in factory overhead means that there is under applied overhead that cost of goods sold must be increased by. A credit balance in factory overhead before the adjusting entry means that too much or an over application of factory overhead went into work in process, and the cost of goods sold account must be reduced. Okay, that takes care of transaction E. Transaction F, which is on page 881, I'm sorry, that was transaction F. Transaction G, which is on page 881, we're told that job 71 is fully complete and we want to take its total costs to finished goods. Now, how do we know the total costs in job number 71? Well, these total costs are going to come from the job cost sheet, and the job cost sheet for job 71 would be the total of the material that was allocated to job 71. That would be $2,000. The total of the direct labor that was allocated to job 71, that is $3,500, plus the overhead that would have been allocated to job 71, which we have yet to calculate. So let's see if we can calculate the amount of overhead that would go specifically to job number 71. So job number 71 had 350 hours attached to it. So 350 times our predetermined rate of $5 an hour would give us $1,750 for the factory overhead. So adding the direct material, the direct labor, and the factory overhead for job number 71, 2,000 plus 3,500 plus 1,750, job number 71 has $7,250 attached to it. Okay, and that would be the journal entry that we would make to relieve job number 71 to the finished goods. Okay, let's move on to the next item. We have the total costs of the job 71 that has moved from work in process to the finished goods, and we can see that beginning inventory plus material, labor, and overhead that's been allocated to work in process, less the finished jobs that have been moved out of work in process to finished goods, leaves an ending balance in work in process of $21,000. And as you can see, the beginning balance in job number 71 was $3,000 plus material, labor, and overhead added. That would be $7,250 that we just calculated, would give us a total for job number 71 of $10,250. And that's the amount that we see right here. And what is remaining would be the job number 72, this American Series guitars, which consists of $11,000 of materials, $7,500 of direct labor, and $2,500 of allocated overhead. And here you see the ending balance that ties into this subsidiary ledger card for this particular job order number 72. Okay, now from finished goods, beginning balance of $20,000 and $10,250 that was transferred from the shop floor this period would give us a total of $30,250 in the warehouse, and retail stores ordered $20,000 from the warehouse. This beginning inventory was then moved to the warehouses, and so the cost of goods sold is increased and the finished goods would be decreased. So the journal entry to do that would be an increase in cost of goods sold, $20,000, and a decrease in finished goods, $20,000. Now, on page 884 of your textbooks, the company Washburn Guitars is selling its Jazz Series guitars for $850 each. And the guitars that were moved out of the warehouse to the stores, this particular job, number 71, consisted of 40 guitars. The selling price of these guitars, $850 times the number of guitars, 40, $850 times 40, results in a selling price of $34,000. So Washburn Guitars would increase accounts receivable and increase sales by $34,000. And we will show this in the cost of goods account for the sales, for the cost of sales, and in ledger accounts that do not appear in this framework up here, we would show the increase in receivables and the increase in sales. And finally, the last transaction would be for some period costs that are indicated on page 884. Period costs are selling, general, and administrative operating costs that always would be expensed on the income statement in the period that they are incurred. That means that period costs, selling, general, and administrative costs, do not become part of work in process. In this case, the company incurred $2,000 of sales salaries expenses, and the office personnel earned $1,500. So there would be an increase in salaries payable, $3,500. And because these costs are not associated with manufacturing, but have more of an administrative and a sales function, they are omitted, or they are not included in the work in process account. Okay, so let's review. What we did is to try to illustrate using the example that was in the chapter of work that's on the factory floor, the materials warehouse, the work on the floor, and then the finished goods warehouse, and associate them with the accounting records. The raw materials cards, in this case for maple, oak, and hickory, would be shown in a materials ledger subsidiary account. Each different raw material would have its own ledger card showing increases, decreases, and the balance. And you can think of this as a big T account. When material is ordered onto the shop floor, it's done with a written document called a materials requisition. And this materials requisition identifies the job to which the different items of raw material go. Labor is traced to the goods that are being made by using time tickets or swipe cards in modern manufacturing. Again, the number of hours worked times the pay rate for the individuals that do the work would accumulate the direct labor that's attached to the specific jobs. Overhead, as we mentioned, is allocated or averaged to the various jobs by this technique called a PDR, predetermined rate, that's done at the beginning of the period. So this predetermined rate is an estimate. It's an estimate created by taking the estimated cost that the business thinks it will have in the current month, divided by the estimate of the number of, in this case, direct labor hours that it thinks it's going to work in the next month as its activity base. And finally, the work in process account is a T account summary of the cost of goods manufactured that we discussed in the previous chapter. That's it for chapter 19. Give the exercises at the end of the chapter a shot. As always, if you do have any questions, please do not hesitate to contact me.